A question that we get asked, just it's infinite, is what is our basis for appeal? What are we appealing? How are we appealing it? And then how does it end up affecting the tax bill at the end of the year?
Yeah. We are appealing based on two things. It's market value, so you're not being appraised based on what market conditions and factors are going on for your property, and the other is equity.
Explain that real quick. A lot of people get confused, like what equity are we talking about there when we say that?
Yeah.
Go into that.
Equity is not like how much money you have into your property. That's a common misconception. Equity is unequal appraisal. Are you being valued equally, the same methods, the same cost factors as other properties in your neighborhood of similar style and design and size and whatnot? That's equity analysis. You want to make sure if you have the exact same floor plan as your neighbor, that they aren't being valued dramatically lower than you. That's equity. That's equitable analysis.
That's one of the things that we actually do particularly well, is because we've got a whole valuation model built out for just about every county that we're in, where, okay, great, if you have the exact same floor plan, your houses were completed at the exact same moment in 2018, and neither of you have touched them since, right? Well, then you have something you can easily compare, but when does that happen, right? So we're able to look at two different properties and make value adjustments between them, just like the appraisal districts do. They're going to look at the different appraised criteria of the property, how old it is, what kind of siding it's got, what kind of roof it's got, and what kind of condition it's in, and make value adjustments between properties to try and keep them equal. And we're able to replicate that and do analysis based on that. We do that on the market side, we do it on the equity of appraisal side as well. And we're able to make a really fine-tuned argument for every property that way.
So going into that, another common question is, how is the county valuing my property specifically? They have 1.5 million parcels they have to deal with. How are they giving me a specific value?
Yeah, well, I mean, I'll let you talk about the commercial side a little bit, but as far as residential goes, what they're going to do is they're going to take the list of appraised characteristics. They've got a spec sheet on every property, basically. They get that from city records, that sort of thing, when the builder builds a development out, when somebody files plans with the city as they're pulling permits for a new custom home. They know what all the appraised characteristics are. They know the size, they know the apportionment of size between first and second floor, they know what kind of roof it has, they know how it was framed, and generally speaking, they've got a pretty good picture of how the house was built and what went into it. Then what they're going to do is they're going to look at when that happened and what kind of depreciation needs to apply to that original cost, the original build cost. And they'll look at what that would be today, basically. If they built it today, what would it cost? But based on how the age of the property, how it's been used, they're going to depreciate that down. And then they're going to look at how that number relates to what similar properties are selling for. And they're going to come up with a ratio of market transactions to that depreciated cost number. And then they're going to take that ratio and they're going to apply it to all the similar properties in an area. And usually that's going to be kind of broken down by style of house. There's different building classes based on those criteria and everything. And they're going to try and narrow that down to the most similar geographical economic area so that they're only comparing apples to apples. But that's generally how they reappraise like that. They kind of go back to the drawing board every year for the most part, right, and refigure out that ratio and apply it to everybody.
And that's called mass appraisal.
That's right.
Right. So the county has to do this every year for...
They're supposed to.
They're supposed to do it every year. Sometimes they don't. Sometimes they don't revalue a property, but this is something that they're doing for 1 million properties a year. And so there's gonna be issues where their value is just not correct for you.
That's right. It's a really hard job to do. They're not trying to do a bad job. It's
right.
Just a bunch of people trying to do their job well. But it's a huge task.
What about so we talked about residential, but what about on our side on commercial? You hear equity a lot, and where does that sit as far as importance of value? Like, we obviously have several different methods of appraising a property, and can you explain some of those?
Yeah, so on the commercial side of things, there's going to be, it's obviously very different than residential. There's going to be an income approach analysis. So if you're a property that receives rents or could be receiving rents, essentially, you're going to be valued on an income approach. That's going to factor in rent analysis in your area. It's going to factor in some sales that have taken place of of similar properties to yours. With residential, obviously, there's a lot of uniformity. These are all living spaces. It's not the same with commercial. Some are going to be retail, some are going to be office. So lots of variations could take place there. So they're gonna look at those and factor in what rents are trending for the past year and try and determine a value based on income there.
Are they, when they look at these market rents, I mean, is that obviously you break it down deeper than that when you work with an individual client, right? Looking at actuals.
Yeah.
And does that help you? I mean, does the county do a good job of when they use market rents?
Yeah, so it's very similar with residential. They have to do it in mass, right? And so if they see that a specific area, maybe a zip code even, is getting this much in Class A or Class B or Class C office space or retail or wherever the case may be, if they're seeing that those are the rents on average, they're going to apply it to your property. Whereas your property might have a situation they don't know about. You're getting far less in rents per year than they know about. And vacancy is a huge issue as well. So you may be at 85% occupied, but the market is indicating that everything should be 95, 97% occupied. It's a big difference, especially on an income analysis. You're not receiving that rent, therefore you shouldn't be valued as high.
Now, what about allowable expenses? Because you have some clients say you do have a non-stabilized property, right? And they do have a 40 or 50% vacancy. And sometimes we do have hiccups where the county won't allow that type of vacancy. They only allow. So can you explain a little bit too, as we collect financials, what is an allowable expense and what is that kind of that standard?
Right. So typically speaking, an allowable expense is going to be anything that's used in the operation of the business being the building. So we're talking about utilities, we're talking about management fees, we're talking about insurance costs, anything used specifically to keep the building up and running.